Oh, baby. Another month and another stocks to buy. We're talking about September 2021 edition here. Hope you're excited about this. We got 4 stocks for you today. I did the research, tried to find great value plays for you. It's hard to find in this market, averaging a P ratio around 35. So I did a lot of that footwork for you, and I tried to find some good ones for you that I think will be pretty good plays for you in terms of value. Let's get right into it because we got a lot to cover today. We're going to start off here with none other than Walt Disney Company. Well, you know Disney. Do I need to say much more about Disney? I don't know if I do, but let's look at the stock itself as we look at it. So we look at historical pricing for Disney. Year to date, the stock hasn't really moved much, up around 0.43%. Not much movement for 8 months of activity. Over a year is up 33%, and 5 years out up 88.99. So close to 89, really. So close, but not quite there. One thing you need to notice with Disney is typically this is a stock that doesn't move much. So this actually recent reaction this past year, year and a half, has been significant movement for them. If you look at a time period between, let's go to the max here so you can get my estimation here, between 2015 and 2019, there was no movement at all. We're talking about a full 4-year period where it moved 8% in the upward direction. So this recent reaction has been pretty significant for them. This stock's traded pretty stagnant for a while. But there's a reason why it's going up. And we'll get to that in just a little bit. We look at the value where the stock's sitting right now. Currently trading at a market cap of $324 billion. A trailing P ratio is not quite fair to really judge it off of. Main reason being that last year they were unable to operate their parks and experiences, which is a great source of profitability for them, and not quite there. But you do see that they're actually returning to a P ratio after not having it because their parks have finally shown profitability for the first time in a long time, over a year. So it's really good news in that aspect. Forward P ratio of 35, again, I think it's a little bit high. And I think it'll be declining there. Price to expected growth only sitting at 1. Pretty cheap historically for them, all things considered. And price to sales at 5. Some might consider a little high, but in my perspective, it doesn't. If you look at the revenue standpoint here, here's why it's trading a little bit lower than you might expect. 2019 brought in $69 billion. Trailing 12 month, I've only brought in $63.5 billion. So it's declined, and the reason for that being is the parks department. So parks and experiences, again, that will inevitably be a great number for them. Whether or not be the end of this year or next year, we'll see what that looks like for them. But the recovery is certainly there. What do I like so much about Disney? Well, there's a lot of things I like about Disney. You look overall, and if you look just on the main website itself, what are they going to show you right away? It's going to be Disney Plus. And this is why this stock has taken off to where it has. So this company has transformed from a traditional media company now to a modern streaming company. So Disney Plus is the main focus for me on this stock right now. Obviously, we have Parks and Travel, which will continue to show growth back to the previous levels that it was at. But Disney Plus is my main focus here. Weird stuff. I just found out about this looking at this. So come September 3rd, apparently there's a exclusive Billie Eilish movie concert experience for her new album. Billie Eilish, not a huge fan of her, I guess, but she's the bad guy. On top of Disney Plus, they also have other services. You talk about ESPN Plus and Hulu, so it's worth mentioning them. We'll get into those numbers as well in just a little bit. But here, as far as Disney Plus, they prove that they are the king of content. When you look at exclusives for them, obviously you have Jungle Cruise, which came out in theaters. But in terms of exclusives, we've got, Disney Plus has Billie Eilish, okay. But look at some of these things and tell me you're not excited. If you haven't looked into this, I'm sure you are. Star Wars Visions, Marvel She-Hulk, Marvel Miss Marvel. These are all series, by the way. Willow, Ironheart from Marvel, Secret Invasion from Marvel, Star Wars Obi-Wan Kenobi. Going to be a movie, I believe. Going to be excited about that one. Star Wars Andor Landor. Going to be great about fighters. It's just exciting. Marvel, Moon Knight, Hawkeye. Everyone's excited about Hawkeye. Come on, we want to see that series. We really do. Armor Wars, Marvel. I Am Groot, Marvel. Guardians of the Galaxy Holiday Special, Marvel. These are exclusives coming soon to Disney+. Ahsoka, it's a Star Wars. Star Wars, Rangers of the Republic, and Star Wars The Book of Boba Fett. These are very exciting exclusives. This is a company that's really focused on Disney Plus right now. They're spending a lot of money on original content, and frankly, no others can compete with this. None of the competitors have exclusives quite like Disney Plus. Some of the exclusives they do have, well, it's great. What? How to Stay at Home? Goofy? I don't know what that means, but you've got great series going on right now, like What If, which is an animated Marvel series of alternate universes, which obviously is related to the current iteration for them. So, great stuff going on here right now. Stuntman, didn't watch that one, but there's so many exclusive shows that you never know. Turner and Hooch, they're bringing that back. Why not? Monsters at Work, a Monsters, Inc. series. Who would have expected it? Loki was a banger. Obviously, The Mandalorian being their main staple as they just started. It's great too. Show me more. Just show me more, please. Star Wars Biomes. Did you ever want to look at some of the scenes they filmed Star Wars at? You have The Bad Batch, which is close to obviously the animated Star Wars series. Great stuff. Falcon and the Winter Soldier. Heard that one was garbage. But yeah, they have so many exclusives. It's incredible. You wouldn't expect much out of them. So let's look at their most recent earnings, and I wanted to pinpoint some things for you. And I talked about Parks and Recreations, and you see how much of a significant factor it was. In the trailing 9 months, when you're talking about June of last year, they made $14 billion, and that compares to this year, they only made $11 billion in that time period when they started reopening. So Parks is a massive, massive segment for them that will be reopening. But what I really want to pinpoint on these earnings, most recent earnings, by the way, is going to be these subscriber numbers. This most recent number here from July 3rd, they posted 116 million Disney Plus subscribers, which is 100+% growth of the year prior. Significant. ESPN Plus also growing 75% in terms of subscriber usage. And Hulu, total Hulu grew 21%, grew both in the SVOD and live TV segment, which is a massive, $80 subscription for them. But this is what I really, really like about this company is subscriptions, not only the Disney Plus segment, which is personally my core segment for them. It's great for them. But you see growth elsewhere as well. I mean, you see average revenue per user is great in terms of Hulu, for sure. And Disney Plus, typically because they bundle it, it's a little bit less, and obviously the price of Disney Plus a little bit lesser. But look at this SVOD, or in live TV, $84, increased 23% in terms of average revenue per user. So I like a lot about Disney, but streaming, obviously the main core. But we also have, you can't mention Disney without box office. So if you look at box office, who's the winner for Disney, or for box office? It's Disney. You see Disney here everywhere, from Black Widow, obviously the number one grossing this year, and will end up the number one grossing. Jungle Cruise up there, Cruella up there, Free Guy, which they just released, is doing very well. $100 million cost to produce, but they've already passed that. You're talking about worldwide box office. These are just domestic numbers too. Raya and the Last Dragon. If you see Disney, they're going to be top of the list. And again, these are weak numbers, because if you look back to 2019, when box office was in full effect, and again, people are still not necessarily going out to all theaters quite yet. Let's look in 2019 and see the difference. You see the difference here. But first off, do you notice something here? Who's owning the box office? 7 of the top 8 are Disney movies. Are you kidding me? 7 of the top 8 were Disney, because Disney owns the box office. If they release a movie, it's typically going to be in the top 10 for the year. And this has been a weak year of releases, so that's why they're not quite all there. But they also own 20th Century Fox now, so any 20th Century Fox feature is, they're going to be taken over in that aspect too. But look at these bangers here. Avengers Endgame, which is the highest grossing of all time, by the way, brought in $850, oh my gosh. $858 million? That's a lot of money. That's a lot of money, by the way. And that's just domestic box office too, by the way. But let's just keep that into consideration. So that's what I got for you in terms of that. But if you look at this year's numbers and compare it, obviously, to years prior, it looks lesser, 180 million in gross. But on top of that, they've also been releasing these on Disney Plus, and they've been able to bring up in just Black Widow alone $125 million in sales on Disney Plus. It's a $30 charge to watch it at home on Disney Plus with premium price. Otherwise, if you wait, they'll release it for free, so consider that. But they generate $370 million worldwide in box office and $125 million in sales just on Disney Plus. So it goes to show that they're able to make money in every way possible. And you have upcoming films too, so it's worth mentioning upcoming films for Disney once it loads, and I assure you it's going to load and be very happy for you. So what do we have coming up for Disney this year alone? First off, you've got Shang-Chi, Legend of the Ten Rings. People are really excited for that. It's a Marvel. Should be a pretty good one. 20th Century, they have The Last Duel. That one looks pretty exciting for me. What else looks pretty good? Marvel Eternals, going to be really the first or second movie in the new era of Marvel that takes place after Loki. So consider that. Again, that's the thing. These Marvel series too that they released on Disney Plus, they're part of the main canon, so you got to watch them too. So you have to be subscribed to Disney Plus. But then Eternals, the main movie, coming right after that. Technically, we have Disney Encanto. Spider-Man, everyone's got to be excited about that. Spider-Man No Way Home, people are going to be pretty hyped about that, is all I can tell you. And then we have Kingsman as well coming out for him. So that's just this year, and again, next year is going to be a much larger slate for him, and it's going to be a great year for him in terms of box office numbers. That's why I like Disney. I think it's undervalued for where it's at in comparison to the competitors. I like Disney a lot, so let's move on to the next one. It's going to be Target. Target, as some might say. I like Target a lot, right? This is the place that it's much better to shop than certain places. Not going to call it Walmart. I like Walmart a lot. It's my largest position overall. But again, I'd much rather shop at a Target. It's more expensive to shop at Target, but the experience is so much better. Stores are cleaner, more organized, less disruptions in terms of clientele, let's say. I think that's a fair way to say it. But one thing you need to notice with Target is the stock's been booming. 65% in the last year, 252% in the last 5 years. So the stock has been taking off. But I still think it's very undervalued. We look at the stock and overall, in terms of valuation, trading at a market cap of $122 billion, a PE ratio of 20 and a forward PE ratio of 20 as well. That's darn cheap compared to the whole market. And historically for this company too, it's trading cheap. Price to expected growth at 2. Relatively cheap there, and price to sales at 1.2 is very, very cheap. You look at the revenue on this company, and you see just how much they've been able to grow. It's quite incredible. $78 billion in 2020, the year prior to 2020, which some may say is 2019, all the way to last year, $93 billion, and trailing 12 months is actually still growing on top of that number, $100 billion now. They've grown an additional $7 billion on top of that line already. It's really nice. I don't really need to say much about Target because you know what Target is and what they do. Retailer, great retailer. I mean, they sell products from, everyone. Let's look at the most recent earnings because I'll show you some great stuff. There's some good highlights that I really like to talk about. Growth in traffic. Store comps increased 8.7, and that's on top of 10.9 the year prior. Digital sales grew 10%. Sounds a little bit light. Because e-commerce is a big focus for them. But again, that's off of 195% growth last year. They tripled the numbers last year. But in that segment, what's really significant here is same-day services. Order, pickup, drive up, and shipped grew 55% this year and 270% last year. They grew nearly 4 times last year. That's incredible. And that's something that's fantastic because that offers a whole new demographic for them, those who don't want to go into store and just want to do online services. This is going to be a massive growth for them in the future. Will continue to grow by massive percentage lines. It's going to be great for them. And more than 95% of second quarter sales were fulfilled by stores. So one thing, if you don't know in terms of the retail industry, they're really focusing on reducing the strain on warehouse and bringing that more towards store level. So in terms of orders like shipped, they're going to be working on fulfillment through the store level. So they're going to be shipping it out through the store. Warehouse sends to them, and they organize it from there and ship it out from there. So the warehouse only has to worry about sending the product out, and they're going to be making these warehouses more efficient in that aspect. So really exciting to see that line there, and that's why they mention it, because if you didn't know that, it just shows that stores are going to be a lot more useful in the future and really streamlining the supply chain. All 5 core merchandising categories delivered positive comp sales. That's crazy, given last year's incredible numbers. And on top of that, the board of directors knows that this is a cheap stock because they've now approved an additional $15 billion in share repurchases. Now, that's not the only way you're going to get value out of the stock, too. This is a stock that is a dividend king, a monarch of the dividend variety. 53 years of dividend growth. 5-year growth rate of only 5.2% isn't significant, but the payout ratio is only at 27%. So 50 plus years of dividend growth, yielding 1.4 is incredible right now. But again, you get that dividend yield, and you also get great capital appreciation, as I showed you with this stock over the last 5 years. Great capital appreciation. So it's the best of both worlds with Target, in my opinion, valued pretty darn cheap. No major X factor here that breaks it off like Disney had with Disney Plus, but it's just a great value stock and one to hold in your portfolio, and you're going to love it over the next 5-10 years. Next is Penn National Gaming. If you don't know Penn, this is a gambling company, right? Entirely focused on gambling, whether it be from sports gambling to physical gambling in casinos. So look at the stock's performance. Obviously, it's been great over year to date. Not much performance because it's fallen quite a bit. 52-week high here of $142. It's fallen quite a bit since then, around 39%. 1 year performance, a little bit of a different story. We've seen significant growth, 48%, and 5 years also significant growth. But I still think there's plenty of value to be had here, and I think it's better around the $140 line than it was at. So why is that? Market cap of $11.5 billion, trailing P ratio of 21, and a forward P ratio of only 15. That's very, very cheap for a company that's growing quite like it is. Because you look at the revenue line, and it's one that's growing. It certainly is. A little bit down from 2019 numbers. That's because casinos were shut down. But we see massive growth back, not only in the casino level, but my main part of this that I like about Penn is going to be the long-term prospects with sports betting. Sports betting it's going to take over. So we're going to see growth here in terms of this, and sports betting is going to take over and go crazy. So what is it about sports betting? Just to put into perspective of where this might be. So alone, PlayUSA.com is expecting the betting pool to be around $20 billion in wagers in NFL and college football games alone. Obviously, the main betting scene is going to be in NFL games. It just is, but college as well. And then other sports betting is not quite as high, but you'll see it. That is a significant amount of wagers expected this year alone, and that's going to be continuing to grow. If you look over the projected future, ARK Invest is estimating that the sports betting market will be worth $37 billion by 2025, and I think it'll probably be worth actually more than that. 11 states have passed the $1 billion in wager marks already. So again, this is going to be something that people are itching to gamble, and once it gets legalized, which is my next point here, but people are going to be betting. They're just going to be betting. And if you look at legalization, because it's worth mentioning, not all states are even legal yet. So that just shows another avenue for massive growth here. The states in red are the ones that have legalized it. The ones in blue are ones that have passed a bill that will be legalizing it. So new markets coming into play with Washington. Florida's a massive one for them, and Louisiana, because you talk about college sports betting, Florida and Louisiana will be there. And on top of that, the ones in dark gray are those that have introduced a bill but haven't passed it yet, And in my opinion, these states will, within the next year or two, legalize sports gambling. The massive one for them is going to be California in terms of population. But in terms of stuff like college betting and NFL betting, you talk about Texas, Alabama, and Georgia, it's going to be a very significant segment for them. Because in my opinion, I mean, let's be clear. The SEC, they're going to be doing a main factor of this sports betting. People are going to be betting a lot on SEC games. So keep that in mind when you look at colleges like Alabama and Georgia. People are going to be definitely placing a lot of bets on Alabama and even Louisiana, obviously, too. Mississippi, too, don't forget them. But great stuff here in the future in Ohio when you talk about Ohio State. So there's a great future for, in my opinion, sports betting into the future. That's why I really like Penn at these levels. I think it's trading really cheap, and the growth potential is certainly there. So, that's my opinion there, and they will continue to expand. They obviously own, Barstool Sports, so you learn that in terms of a news aspect. And just a media platform. They also just purchased The Score, which is another media platform, most known for news articles, but again, another aspect when this company's just continuing to grow. So let's move on to the final one here in HP. I saved the most boring for last. You might not expect that, but it's going to be HP. Why do I like HP? Some may ask because it's a very boring stock. You look year to date, the stock's actually up 16%, but from its highs has fallen quite a bit, around 20%. Performance over the last year has been nice, 50%, and 5 years has been very nice as well for a stock that traditionally trades pretty stagnant. But I think this stock's very undervalued, all things considered. You look at the valuation here, market cap of $34, nearly $35 billion, a P ratio of only 10, and a forward P ratio of 8. 8! That's darn cheap. That is darn cheap. I don't know what else you want me to say about that, but price to sales here at 0.63, it's trading just dirt cheap. I mean, there's no other way to say it. You look at the revenue line here. What would make it trade cheap like that is, in my opinion, a revenue declining company, but this is not that. The company's at a trailing 12-month revenue here of $61 billion. That compares to 2019 numbers of 58, and last year's was a little bit lesser, which isn't their fault at all. We talk about supply chain constraints, but this is a company that's consistently growing revenue, yet is trading at a ridiculously cheap multiple. What do I like about HP? Well, there's a lot that I like about HP. So you look at their home, obviously they're most known for printers and PCs. PCs I like a lot for them in the future because you talk about school from home. I like it a lot. But what's a program I like too? I really like this Instant Ink program from them. This is a program that allows you to your printer will sense when you're low on ink, and it'll automatically place an order for more of that ink. It'll get shipped directly to your house. It's a subscription service, so you can do a subscription service for ink as opposed to waiting and then running out of ink and then being absolutely pissed when you don't have ink to print out what you need, and you need it right then and there. Because we've all done it, we go to print something and we don't have ink, and we hate our lives because we have to, we need what we printed within the next day. Now you got to go out to the store, sucky, find your type, pay so much money for it. We don't want to do it that. HP Instant Ink, it's the way to go, okay? It's a great process. What else do I like about HP? This is one thing I learned about them that I haven't heard a lot about these platforms here. VR products. HP has VR products, and not ones I've actually heard of. The Reverb G2 headset, never heard of it. Omni Concept Edition, never heard of it. State-of-the-art sensors for real-time data capture. Curious on this. I'll have to look more into these and how they function, but I'm curious on how that looks, though. And what's also really cool here, too, is this HP VR backpack, right? So some of the issues people have with VR is all the wires that are associated with the headsets, and you can get tangled up. You don't necessarily get a 360 feel because you'll get tangled up in wires. With this backpack, the wires are attached to you as opposed to attached to your PC. So I really like that in that aspect where you could really go with the console as opposed to being really wired in and stuck. But you see what it does to your hairline here. I'll just tell you that right now. It destroys your hair when you wear a VR headset. But That doesn't necessarily have anything to do with it. But I also like the 3D printing segment on this. I think it's one that'll certainly go a long way for them. 3D printing is going to be massive for them in the future. In fact, it's expected that this market will grow to a $36 billion line by 2026. Crazy. Expected to be $12 billion in 2020, and expected to be over $36 billion in the future by 2026. Let's refresh this bad boy. Don't you worry. Don't you worry. We're gonna show you here. You're gonna joke with me, view for free. So yeah, I'm really excited about this for the future. It's expected to grow significantly. Sorry, I didn't pay for my Statista chart, but 17% annualized growth rate to 2023, and expected to grow even further beyond that. Why I like 3D printing is not only for business use, because manufacturing is a lot cheaper that way. They can do a lot easier with 3D printing, but for consumer use in the future, we will see 3D printing as well. Whether it be small parts to add on to something that broke, from a screw onward. 3D printing has so many potentials here. In the future, I like it because we talk about people that create programs or models online that you can download and print based off of that. It's just going to become a more household project in the future, or product, I should say, in the future that isn't quite essential, right now. Right now, it's more of business use. But again, the market's going to grow significantly. That's why I like these stocks. That's what I got for you. Disney, Target, Penn, HP, look at them. Hope you have a good day.